Chapter 3, Part 1. Now this is the final part of the 1 through 3, and we're going through the whole accounting cycle, and now we're doing the last part, and we're going to do adjusting entries in Part 1, and then we're going to do financials and close the books in Part 2. Now first, in order for you to understand why we do this, you have to understand in accounting the time period concept, which means that accounting information is reported at regular intervals, usually a calendar year or a fiscal year, any 12-month period. Some companies start July 1st and end June 30th. So every company is different. A lot of it has to do with their operating cycle. And we also have interim periods, and those we can do monthly or quarterly, but the big one is the annual report. Now, the accounting cycle. We talked about in Chapter 2, analyzing. Those are financial transactions. We journalize, we post, and then we prepare an unadjusted trial balance. And this is primarily to make sure our debits and credits equal, and that we can spot any errors like balances not being correct, things like that. Now what we're going to talk about, and this is done all during the month, and remember we are posting in chronological order, and then at the end of each month what we do is what we call adjustments. And once we make these adjustments, we can prepare our second trial balance called the adjusted trial balance. This is the only one that you can prepare financial statements from. We then prepare our financial statements, and then the last thing, and we'll cover this in Part 2, is we'll close the books and we'll prepare the third trial balance called the post-closing trial balance. And again, this is only done at the end of the year after we prepare the financial statements. Now, we have two principles that require us to do adjusting entries. These are the revenue and expense recognition principles. And the revenue recognition principle is that revenue is recorded in the period in which the goods and services are provided to the customer. The expense recognition principle, any costs used to help generate revenues are recorded as expenses in the same period as those revenues. Now, the revenue recognition and expense recognition principles take us away from the whole idea of cash driving revenue and expenses. Now let's take a look at that. Most people think of, in their own personal lives, they keep track of things on a cash basis. They have revenue when they receive the cash, and they have expense when they exchange it for some kind of service or goods. This is not GAAP. Under GAAP, because of the revenue recognition principle and expense recognition principle, we have to do accrual-based accounting. And what that means is that revenue is recognized in the period goods and services are provided to the customer, which means, here's an example, if we got money in advance of services, we would not recognize it as revenue because we haven't provided the services. If we provided the services and we got the cash, we'd recognize revenue. And the other thing that can happen is we do the services, however, we haven't billed the customer yet. Even though we haven't received the cash, we would recognize the revenue because we've earned it. And the same thing applies to expenses. We have to book them in the period they are incurred, regardless of whether cash changes hands. That is generally accepted accounting principles known as GAAP. Now, the adjustment process. At the end of the period, a business prepares financial statements. In accordance with the revenue and expense principle, we must determine if accounts reflect all revenues that have been earned and expenses that have been consumed. We do this by making adjusting entries that affect both the balance sheet and the income statement accounts. There are three categories. There are deferrals. These are items that are already on the balance sheet. An example would be we have prepaid insurance, but time has gone by and we've consumed it. Or we have office supplies and we've used them up. Or we've received revenue in advance and now we've earned it. Next, depreciation. if we have long-term assets, we have to allocate those costs over the benefits we receive that time period. And accruals, not on the books, but the revenue has been earned, or sorry about that. So accruals, these are not on the books at all, but revenue has been earned or expenses have been incurred, we just haven't recorded them at all. Adjusting entries never involve cash, i.e. you will never debit or credit cash if you are doing adjusting entries. Now, first we have our deferrals. An example would be a prepaid expense. They're recorded as an asset when purchased and they're expense when used or expired. Unearned revenue, recorded as a liability when payment is received, recorded as revenue when it is earned. So let's take a look at an example. We earned half of the deferred revenue at the end of the period. Again, this is from the same problem we had from Chapter 2, presentation. So we had $30,000 on the books, and now what we've done is earned half of that. So what we're going to do is debit deferred revenue, and we're going to credit sales. Now, again, if you look at the two accounts, we now have $15,000 left of our liability, which is on the balance sheet, and now we have another $15,000 on our income statement. So again, they're always affecting both the balance sheet and the income statement whenever we do adjusting entries. Now, the next thing that's happened, it's the end of the period, and we've done a physical inventory, and we see that we have $1,000 worth of supplies on hand. So what that means is, sorry about that, clicked the wrong button. Okay, start over again. All right, so we had $1,000 worth of supplies on hand, so now we have to make an adjusting entry because our balance sheet office supplies is no longer $5,000. So what we need to do is expense the difference so we can bring that balance down. And now we have $1,000 in office supplies, and we have used $4,000. So that's our remaining amount, and that's the amount that we've consumed. And this is the balance sheet, and this is the income statement. Now let's take a look at depreciation. Depreciation allocates costs of plant assets to expenses over useful lives, also called tangible assets. Now remember, this depreciation only applies to assets that have a service life. They're used by the company for more than 1 year. We're going to have two new accounts. Depreciation expense, the amount expensed in the period on the income statement. Depreciation expense is only for tangible assets used in the business. Accumulated depreciation is the sum of all the depreciation expense over the life of the asset. It appears on the balance sheet and is a contra asset account. The balance is the opposite of the account it follows, so it is an asset with a credit balance. Example. What if you bought equipment for $90,000 on January 1st with an expected service life of 3 years? We would allocate the $90,000 divided by 3 years, or $30,000 per year, as depreciation expense. What if we didn't have a contra account, and instead we just reduced the equipment account? So the first year on the income statement we showed expense of $30,000 each year. But on the balance sheet, what we would see is at the end of the first year, all we'd see is 60, because we've already reduced it by 30. In year 2, we'd show 30, and in year 3, we'd show we had no equipment. Now, because we use the contra account, what it allows us to do is show us how much has been invested in equipment, and 2, via accumulated depreciation, tell us how old the equipment is. So, for instance, if we bought this company in year 1, we'd know we have relatively new equipment. However, if we bought it in year 3, we might want to adjust the price to allow for the fact that we're going to have to buy new equipment. That's the reason we have a contra account for equipment. And we have a contra accounts for other things also. This is just the first of many. So, as you can see, they show the same net amounts, but the contra account tells investors how much has been invested in equipment and if it will need to be replaced. Now, let's take a look at the journal entry. So, we would debit depreciation expense and we would credit accumulated depreciation. These would be on the balance sheet and this would be on the income statement. Now, what would it look like on the balance sheet? This is what it would look like. We would show the equipment less accumulated depreciation. Usually if you say less, you don't put brackets, so one way or the other. And you notice you're subtracting. Remember, you always subtract accumulated depreciation. So we now have a net book value of $27,000 at the end of year 1. Now let's take a look at accruals. Now accruals, they're not on the books at all. What are accrued expenses? Well, accrued expenses would be to record expense before paying the cash. An example would be it's the end of the month. You have salaries you owed, but you haven't paid them. You may have interest that is accrued on some notes, or you might have taxes payable, or you could have utilities payable. These would be the kind of accrued expenses. Now, accrued revenues would be you have to record revenue before collecting the cash. Example would be you've done the work, but you just haven't invoiced them yet, so it's not on the books. These are what you would do adjusting entries. These are accruals. Again, they're not on the books at all, and now we're going to put them on the balance sheet and on the income statement. So, the notes payable has an interest of 12% and 6 months have gone by. What amount should be accrued? Well, we'd take the $10,000 times 12% equals $1,200. That is the annual depreciation expense. But to get it for half a year, we would divide by half or take it times 6/12. So our journal entry would be interest expense and interest payable. You do not put the interest in with the note. You usually like to separate them out. This would be on the balance sheet. This would be on the income statement. Now, what happens if we provided services on account for $600? The accounts receivable would be $600 and the sales would be $6,000 and $6,000. We then add them up and this would be on the balance sheet and this would be on the income statement. Now let's take a look at our general ledger after we've made all these adjusting entries. Here's what we would look like, and we would show the totals. If you notice this, I have the totals for each one of these. And now what we're going to do is we're going to prepare an adjusted trial balance. This is the one you're going to use to do the financial statements, which we do in part 2. So, first, we're going to list all of our assets. Now, the balance sheet, the trial balance is always shown in financial statement order. Usually they're assigned numbers, and when they're listed, this is the way they're sorted. Now, then you would list your liabilities, again, based on when are they going to be paid, the assets based on when we're going to get the cash. Then we're going to show our equity section, and then we show our income statement. And now we make sure our totals are the same. And now this is what's going to be on our balance sheet. This is what's going to be on our statement of stockholders' equity. And this is what's going to be on our income statement. And this ends our part 1, chapter 3 of a 2-part series.